one is a gravel bike.
Are we recording yet?
We're recording now. So just let me look at this real quick. Jesus Christ.
What?
It's like so scrubbed. It's not my biggest challenge is that I'm not used to this.
Well, it's a more specific technical topic than
It will work out fine.
it's not like a war story topic.
Well, we're not telling war stories today. We're talking about finance
and accounting.
In
fact, you'll hear more about accounting and the word accounting today than you will finance. But
well, let's talk about that in a second.
Yeah.
Can you? Yeah, you'll be able to talk about that.
Yeah, I can talk about.
No, we're going to start right now.
All right. Well, let's talk about it then.
Let's talk about. Yeah, we were just. Hey, well, everyone, welcome. We are talking about accounting and finance today with Sean Lamb. I asked Sean to come in here and do a deep dive on finance and accounting because it's one of the least. Well, I don't know if it's really sexy or not, Sean. It's actually sexy because you make money, right?
If you're making money, it can be sexy.
Well, or you're on the path to make money. But do a deep dive on this for everybody because you never hear about it or don't hear about it in podcasts often, and it's really important. So we were just talking before we started recording. What do you think the difference is between finance and accounting?
Yeah, I think it's a little bit of a not chicken and egg, but accounting has to happen and has to happen accurately, timely, so that then finance can take those accounting numbers and help drive strategic decision making in a company. So you can't really go do finance work unless you have some reliable numbers to tell you what's going on in the business. Once you have those, you have tools that you can then go and support decision making, do analysis, decide if part of the business is doing really well, another part might not be doing well. So I kind of view this, it has to all begin with accounting. And after you get your accounting locked in, it opens up a whole host of areas in the business for people to be able to do their jobs.
So does accounting traditionally report directly to finance?
Yeah, I mean, traditionally in a company, you'll have a chief financial officer, and he'll oversee accounting.
Or she.
Yes.
So they will be in charge of accounting, but they'll be a head of accounting too.
They will be, but as a company gets bigger, you might have a chief accounting officer that's not the chief financial officer. It just depends on the size of the business, and that would be a fairly large business when you start getting to adding those types of levels in the accounting.
Like what's that? 400, 500 million?
Yeah, 500 million, maybe a public company. You would definitely have a controller who's probably also your chief accounting officer. CFO is sort of, you're a leader in a company. And so you have to make sure the books are closed. You have to make sure you're supporting the business in their decision making. You have to help people grow and develop in their careers on your team. You have to be an active member of the executive team, thinking about strategy, execution, operational efficiency. You have to be a little bit of expert in everything. You can't, you don't necessarily need, besides the accounting and finance, you don't need to be deep on any other area, but you just need to be experienced and intelligent when it comes to these other topics, because those executive level seats are so critical. There's only a couple of them, right? And so everyone at the table has to be able to wear a lot of different hats for that team to be super effective.
So let's just real quick go into your background so everybody knows that. I asked Sean, we ride bikes together almost every week, sometimes a few times a week if the weather's good and he has time. But Sean joined Dolby when they were at 500 million. Maybe you could just give a little bit of background because you were there for, I think, 15 years and it doubled in size while you were there. And you worked your way up all the way towards the top there before you became a CFO.
Yeah. So I started out my career sort of investment banking, that New York lifestyle. There's like a HBO show on it now. And then went to get my MBA and sort of switched over to the corporate side about 20 years ago. I've been in companies that have millions of dollars of revenue. I've been in companies that have over $1 billion of revenue, Dolby being the one where I spent the majority of those 20 years in corporate. Um, and yeah, Dolby was about 500-600 million when I joined. It was a public company at the time. We doubled that before I left. But also, underlying that double story, everyone wants to always talk about the double, right? But in those 14 years, there was a lot of ups. There were some downs. There were some periods of flatness. And all of those experiences, I think, are much more valuable having that diversity of experience than just being like, I was at a company and because of something maybe we did, something maybe extraneous to us, this thing just shot to the moon. Having gone through those cycles, I think is really valuable. And so, yep. So, and then I've been at companies in between those two in finance leadership roles.
Did you do investment banking before you got your MBA or after?
Before, right out of college in New York City, work till midnight, go out and have drinks with friends till 2, and then start back again at the office at 9 a.m. It was a fun time and hard work, long hours, but they typically would buy you food and give you a car ride home at the end of the day. And everyone else in your friend network is sort of doing the same thing. And so those are great years and great learning experiences.
You were a what do you call it? NCAA national championship rowing champion at Princeton.
I was lucky enough to get recruited into some great universities. I chose Princeton, and we were very successful there. We had a great group of guys because it was an all guys team. Also had a great women's team there. I think they might have been even more successful than we were, but and a great group of coaches. A lot of the guys on that team rode for national teams around the world. The coaches coached national teams around the world. So really lucky to be in that moment and still have a lot of those relationships and close connections with those guys till today.
Yeah, we actually had, I think, one of your classmates on, Marty, who runs Princeton Wheelworks, right? Was he in your class? Princeton Carbon Works. Was he in your class?
He was. I want to say Marty was either 2 or 3 years behind me. He was a much better athlete than me, but a salt of the earth kind of guy. And our whole team was like that. You would think at Princeton maybe it'd be a bunch of stuck up rich kids. That was not the case. We were all down to earth people, and a lot of them, like Marty, have been very successful since those days long ago. And Marty's fantastic, and his Princeton Carbon Works. What a story!
It's a great story, and his wheels are fast. And he also coaches the lightweight, I think, at Princeton.
Lightweight men's coach.
So you do that, you go to investment banking, then you go to Stanford Business School, then you do a few startups, then you go to Dolby. You also have a CPA. Do you think that most CFOs have CPAs?
I think the tide. I saw the tide shift again back to sort of being in the game for a long time. It was around the .com crash. Before that, a lot of CFOs did not have CPAs. They came from the investment banking side over to the .coms. They came across the country and were CFOs. When that happened, the power sort of shifted towards CPAs and the accounting profession and away from sort of the high-flying investment banking profession. So
why do you think we screwed it up when we
got out of balance? It got out of balance, right? And so I always said to myself, because I didn't actually work ever in an accounting firm, right? That was actually one of my goals. I didn't really want to do that. So I said to myself, I just want to get a CPA, because if all else is equal between me and another candidate for a job, I don't want the CPA to be the one thing that they have and I don't. And so I went out and got it. I did it, at night while I was, I had to take a couple courses to fill out my credit load while I was at Dolby, and took the exam. All you got to do is pass. But of course, I did a little better than just passing. And actually I take pride in sort of understanding accounting concepts. I think it's a secret superpower. If you can come in with sort of very, very deep knowledge on certain areas of accounting, the one that comes to mind is revenue recognition. Everyone has revenue. And so if you have a good understanding of revenue recognition, you can be really impactful at any company. So yeah, so that's why I got my CPA.
But a lot of people, yeah, the revenue recognition is especially important in any SaaS business or really any subscription business, especially when you pay up front, right?
It's important in any business. You need to understand there are very specific rules about what revenue you can recognize. Now I mean, a lot of your listeners might be small business owners, and they're not worried about revenue recognition. They're worried about cash sales. How much are they selling every day? Forget about gap accounting and all of that. But as you get into larger companies and you need to have an accounting team closing the books, you need to have audits that give your business validity so that lenders will lend money to you and things like that. Then gap accounting matters and revenue recognition matters. So SaaS subscription models, that's one type of revenue recognition. There's also software revenue recognition. There's project revenue recognition. There's a whole host of different types of revenue recognition, and having a really deep knowledge of that, again, is really something that you can use across no matter what size company you end up at.
But you're going to need that even in small companies that have no revenue and startups. When you get funding, if you're not doing your accounting right, and then you're trying to do a path to some liquidity event, or you're trying to go public and you don't have your books right, then that's a major, like, you do have to have that right.
Yeah, you're not going public if you don't have your books
Well,
right.
I'm just saying, then you got to clean up 5 years and adjust your earnings and all this stuff, and now you look sloppy.
Yeah, no, that, and a lot of our conversations, I think we'll get into sort of like, what are the building blocks that get you to that moment that everyone hopes to get to, which is some sort of exit event, whether it's an IPO or a sale of your business to someone. You know, the cleaner your house is, the more value you're going to get, the quicker the transaction's going to go. It just all builds upon, each step builds upon the prior step, and puts you in a position for success. It's like having a clean house. You never know who's going to show up at your front door, but when they show up, your house is in order.
Yeah, I think it's important. I actually learned that lesson when I sold my first company. We had subscription business. I was, what you said, trying to think about how much just cash we had, but people in that instance were buying some subscriptions for a whole year. Theoretically, you should recognize the revenue each month and put a debt on your balance sheet. And I know for some listeners, this may be getting into the weeds, but you need to understand to be in the weeds. At least know the right questions to ask, because what happened to me is they did show up on my door. I did want to sell it, but because we were doing, I don't want to call it rinky dink accounting, but we were in survival mode, right? So
we're doing probably more of a cash-based accounting.
We were absolutely doing cash-based accounting. That's how I was doing the accounting, because it was easier and less expensive. However, when we went to sell it, I had to redo all of in a spreadsheet, all of that revenue recognition by month. Even though that's not how we filed our taxes, I did have to redo it for the acquisition. And then once we did that, that can change the price. Well, it changes the price for two things. One is you look sloppy, which I tried to recover from and did. But two is it changes your numbers, because now you went from revenue to debt on your balance sheet, because they are going to have a liability that they have to serve from the revenue that we recognize. Right. So it's important to, I'm just driving home that point for people, because even if you do have a small business that's doing $1, $2, $3, $5 million, and you don't get that right, and then someone shows up on your door, they can shave a lot of money off the price that they originally offered you when you get into diligence.
Right. Well, let's just take your example one step further. Someone's looking to buy your business. You're accounting for that on a cash basis. So you get a $120,000 subscription, and you recognize all $120,000 in January. And that's cash-based accounting. Well, someone's looking at your business and they just assume Brandon's buttoned up, and that's his January number, and that number will be recurring, right? Because they're just assuming you're accounting for that subscription accurately and spreading it over 12 months. So when they look at your full year, they're not realizing that you're on a cash basis. And so that's a huge difference in value, right? And perceived value in this enterprise. If all of that's being booked up front and it's not recurring revenue year after year. People love recurring revenue, right? That's what people these days are always looking for. And then if it's just one-time revenue and that customer never reappears, that's not super sexy, not super valuable.
No, I recovered because 33% of our revenue was from subscriptions, and then we had sponsorships and e-commerce sales. So it wasn't the whole enchilada. However, if it was, I would have been whacked, because that's a difference between like what 1.3 million in revenue and $120,000 in
Yeah,
it, right?
right.
It's a big deal.
Yep.
So for listeners, I normally don't do this, but I've prepared a long list of questions for Sean to make sure that we cover it. And we're going to go through those now. If you do have comments or questions afterwards, you can leave them in the comment section and we'll get back to you on those. So let's start with number one, Sean. What happens when you walk into a situation as a finance leader where things aren't working and it takes way too long to close the books? I think I know you're going to have an answer to this, but closing the books is actually not a topic that gets talked about a lot. You and I have talked about it riding bikes, because I've always like wondered. I mean, really, you need to get your books closed, whether you're small, medium, or large business, in 30 days, right?
Yeah, I mean, preferably you're closing your books every month. It doesn't need to be what we call a hard close, where you have every element accounted for. You might wait on something like stock comp expense until the end of the year. Maybe you have that outsourced and you don't want to pay someone to be providing you entries every month. But yeah, you want to close your books monthly, and you want to do that, as a smaller company, within 10 to 15 days, 10 to 15 business days, you want to be done closing the prior month.
From the end. So the 30th, well, say the month ends on the 31st. By the 15th of the next month, your books should be closed, settled effectively.
Yeah.
Could you explain what close means for some people?
It just means that you've accounted for all the business activity in the prior month, and through using GAAP accounting principles, and that you can produce an income statement, a balance sheet, and a cash flow statement. So at the end of that 15 days, I'm hoping to get those three statements. They all interact with one another, and that gives you a really good financial picture of what's going on in the company through numbers.
So you're basically, your accounting department is in a continual cycle, because the next 15 days, well, you have people doing accounting the first 15 days, and then the next 15 days, you're accounting for the expenses and trying to clean up what's happening, basically.
Yeah, it can be nonstop, but that's where sort of the core principles on how to make sure you're being as efficient and timely as possible come into play. So, when I come into a company, more often than not, things aren't perfect, right? The previous person in the role did their best, but they're constrained by resources or money or cash available or other competing priorities at the company, right? The accounting priorities are not always the most important ones, especially in growth companies. So when I come in, I sort of call it three things: people, process, and systems, right? That's where I start. And it's kind of like a three-legged stool. If you don't have one of those three things, people, process, and systems, in good shape, you likely don't have a good accounting close. And that can spell disaster, not only for the close, but also just getting accurate and actionable information out to stakeholders in the company. And so that's where I start. I sort of start in those three buckets. How are we doing on people? Are their staffing levels right? Are people in the right roles? Next one's process. That's also sort of policy. Process and policy are a bit interchangeable. I'll be using those today. Do we have process in place around purchasing, credit card spending, travel, all of those things, inventory management, inventory movement, all these things.
Leases, right?
Leases. Yeah, that's a very specific accounting topic that changed in the last couple of years. And so what they did is they made you put a liability now on the balance sheet for basically all.
So if you have
leases.
a 5-year lease, just for some listeners, you have a 5-year lease, you're 1 year in, they're going to make you account. And let's say it was $1,000 a year. I know it's not normal, but then you would have to carry $4,000 of liability. Well, you probably have to do it monthly on your balance sheet, because it's not assumed that you can get out of the lease.
Yeah, it's basically, you have to sort of capitalize the lease in a way and put it on your balance sheet. Whereas before, you would just run $1,000 of rent every month, and there would be no liability sitting on your balance sheet. So, yeah, there's been some changes to that. So policy and processes are very important. Systems. Yeah, this is the one we'll spend some time on today, and sort of as we go through some of the questions you shot to me beforehand. But systems are really important, but you can over rotate on systems, right? You have to make sure you have the right people to implement the right systems. You have to make sure you have the right processes to enable those systems. If you're going to try to put a Lamborghini into your accounting department and you don't have the right people to drive it or the right policies on how to put gas and fuel in it or keep it tuned up, that Lamborghini's not going anywhere. And so we'll get into all these later. The other thing I'll say is, like, if you don't have a good accounting close, that where you're able to provide sort of information out to the business timely, like if it takes you 25 days to close your books, everyone just forgets about accounting and forgets about finance because they're not helpful, right? If you can get that close timing where we started this first question back to that 10, 15 day range, then at least you're getting information out to people where doesn't feel so much like a month old newspaper. It's more actionable for them. And the last thing where you started was, it kind of seems like a vicious cycle, right? Like accounting never stops accounting. The sooner you can get your close done, the more breathing room they have before the next close starts. So where you'll find really low morale is in situations where it takes 25 days to close the books, and they're already on day 26, they're starting the pre-close activities for the next month, right? And so it never stops. So you want to burn people out, you allow that to continue into perpetuity. That's how you burn people out. That's the way to have a group of people sort of fall apart and have no credibility, outside of your team and the rest of the company.
I do have a question that I forgot to put down on here, I think, is, so could you just off the top of your head, for a small company, so small company under 10 million, can you get away with, I'm trying to figure out from 10 to 15 days, how many people you actually need by revenue in general? Like 1 to 10 million, can you get away with an accountant and QuickBooks?
You probably could get away with one, but you'd probably be better with two.
So a bookkeeper and an accountant.
Yeah, sort of like a controller, and then sort of more of a bookkeeper, maybe a payroll person / AP person. I would say between that, let's call it 1 and 20, you can probably get away with 2 people, maybe a little bit of outsourcing to top that off. The company I'm at right now is 50, 60, 70 million of revenue. We have 4 people, a controller,
4,
a controller and 3 other accountants.
And you.
And then me. Yep.
And then anybody else in finance?
No one in finance right now, which means I do a fair amount of that. And again, I rely on some other people to help me who are.
But you would, in theory, if you're growing, you would next hire of another finance.
Yeah, I would hire 2. I'd hire sort of like a director level person who can do the majority of the critical thinking, modeling. And then I'd hire like a junior person, give them a lot of responsibility, help them grow fast in their career, but they'd be more like a number cruncher, spreadsheet jockey, him or her, just working hard in models and producing reporting.
Right. So how much because I know you've also done a company out from 100 to 500 million.
Yeah.
Well, so what is that in general? Because that's going to change every $100 million.
Yeah, there's sort of gates you go through. I would say, at the company I was at that was in that range, we had about 15 or so in accounting, maybe a few more than that, but still had some outsourced. We outsourced the fair amount of the tax work. We outsourced a lot of the technical accounting there, right? Because do you want to hire a technical accountant? If you're going to be a public company or close to it, sure, you hire a technical accountant. Especially,
I don't even know what that means.
There are really, quote unquote, technical parts of the accounting guidance, the GAAP guidance, where you need someone opining on everything that doesn't quite match up with the examples in the guidance, right? They need to take an opinion, write a white paper as to why they're treating something this way versus that way.
To defend it in case you're audited.
Yeah, well, you're likely going to be audited when you're at the size where you would hire a technical accountant. But there are just things that happen in your business. And you know what? You're a generalist if you're a controller. You have to manage people. You have to know GAAP. You're a CPA probably. And so you would reach out you would have a firm sort of on what do they call it? Retainer that would help you with some of those technical things, like a specific type of contract you've never gone into before, and it has really weird, unique terms to it. You'd want to get a technical opinion on that. You can use your auditors to help with that too. You don't always need to have, rely on outside, but the auditors aren't there to close your books. They're there to review your closed books, right? So you have a good relationship with your auditor, you might be able to ask them a question or two and get away with it. But really, a technical accountant. So at the 100 million to 500 million, you're talking 15 to 20 people in accounting. You have a lot of payroll to do in those situations, a lot of AP. You have
retirement
a
accounts.
lot of people. You might be international at that size, right? So
Oh.
you have to in these accounting systems, you have to close. You'll have different sets of books, right? So you might have a set of books for the U.S., you might have a set of books for the United Kingdom, you might have a set of books for China, and so you need to close all of those books before you roll up into the consolidated book. So you might need local accountants. At Dolby, we had 2 shared service centers doing accounting in Europe and one in China, because they have to process all that international activity. So yeah, it gets pretty quick, it gets the size of these teams grows, especially once you get above 100 million and you're growing to 500 million or a billion and above. You can get into pretty sizable, and you're global in nature, with entities outside the United States operating. You can get to a pretty big accounting team.
So do you think it's linear? So if you go from 500 when you were at Dolby, you go from 500 to a billion, you had 15 people in accounting only. That it is accounting 2 to 1 for finance. You know what I mean? So
It's probably not a bad ratio. I never really thought about it that way. I mean, again, a company like Dolby's global, right? So that was not the example I gave you on the 100 to 500 million, about 15 to 20 people.
US based.
That was a US only based company. Global company, it's probably going to be 20 to 30 at that size, right?
Accountants.
People doing accounting.
Accounting.
Yeah. Doing payroll in Beijing is different than doing payroll here in the US.
Right.
So you want someone in the US doing it, and you're going to want someone in Beijing doing
and then, so is it, if you were doing US, do you think it's linear to go to 30 people in accounting from like 500 to a billion, and then 15 people in finance? So now you're at 45 people in accounting and finance as you approach $1 billion.
That sounds a little heavy. What you hope to get out of this accounting and finance organization is operating leverage, right? So that every time you add $1 of revenue, you don't have to add another accounting head. So you're actually, what you're trying to do as a finance leader is break that ratio relationship that you're sort of keying into here. Maybe there's a little bit of a linear line in between 0 and 500 million, but after that you're really trying to break that linearity, because you're trying to do things more efficiently, more cost effectively, so that every dollar of revenue is not eaten up by 50 cents of additional accounting, right? You want that new dollar of revenue to be eaten up by 5 cents of accounting, right? Not 50. So you try to break that linear relationship at all times, really, right? Find cost-effective ways to do things, whether it's outsourcing, maybe setting up an office in a lower cost area, right? The Bay Area where we are super expensive. Maybe you open something in a lower cost place like Texas or Atlanta, or you open something outside the United States, right? A shared service center somewhere to keep those costs down. So you're always trying to create leverage in that finance and accounting organization. I guess the thing we look at is finance and accounting costs as a percent of revenue, and you want that to be pretty low.
What was low? 3%?
That's high. That's
3% high.
Yeah, like world class. If you're just going to close the books and not provide any real true business support to the company, you're literally just closing the books quickly and paying people timely. You're looking at 1.5%, 1.25%.
But ideally, I want my CFO to provide KPIs.
Yeah. So if you're going to want that business support, then you're going to be closer to 2%.
2% of operating costs or revenue?
2% of revenue.
Okay.
Yeah. So there you can find things on the web.
I know. I just want to provide listeners with like some guidance, right? I mean, because that way when you're running your financials, especially in the early stages or even in the mid stages, I mean, there's a lot of companies that do 25 million that don't have their accounting and finance straight.
Right.
I mean,
but to be clear, those percentages I gave you is at scale, right?
Right.
I think your ratios, the numbers we were doing earlier, that's more early stage through 500 million.
Right.
Once you get above that, that's when you can start applying those ratios, because they're typically based on a peer group that's public companies with publicly available information. And yeah,
I do have one other question before we jump into what are the first steps to getting things back on track, because that's usually what you're going to find yourself in or as a business owner, you're going to have to figure out how to do, is the accounting software. So do you think you can get by? Like everybody uses QuickBooks. When I was doing a government company, basically the rule was that we could use QuickBooks, which is the government is very, very, very heavy on all these ratios and all the accounting. I mean, we had to break out the embroidery. Now, don't quote me, but I'm pretty sure this is right. So we couldn't expense the shirt, but we could expense the embroidery on the shirt. And we, in general, thought that we could use QuickBooks up to 70 million. In a SaaS business, I think maybe you get away with something like QuickBooks to 100 million. Did I already ask that question somewhere in here?
Yeah, you did. Don't worry.
Oh,
Keep going. You're doing good.
And then you're going to have to go to like a more sophisticated enterprise system in the government, which is a separate, totally separate market. And I forget the software we started off with escapes, and we went with a very robust system because we were growing fast and we didn't want to make mistakes and we were going for large scale contracts. But then on the commercial side, when I've done businesses, it's pretty been like, hey, up to 100 million. If we get there, when we get there, we're going to ride with QuickBooks. But then you have to move to more sophisticated enterprise system. And I don't know what those are, but is that a fair assessment?
Yeah. So I kind of highly recommend QuickBooks, I would say, until such time that it feels like you've outgrown it some time ago. So what I'm saying there is I would stick with QuickBooks as long as you can, because enterprise system implementations, ERP, enterprise resource planning, finance and accounting system, big systems, even today's super, cloud, super leading edge cloud solutions like NetSuite, those have a ton of horsepower. The implementations take time and thought that you have to devote to it. And, when you're running fast and trying to close your books in a growing company, I think QuickBooks can really handle a company 50 million in revenue. That's when I would say you would start looking to see what else is out there, what might be a good fit for the what type of business you have, the resourcing that you have on your team. I've never heard of someone saying we waited too long to move to a new accounting system, right? But I've definitely heard of people time and time again say we move too fast to the next the next step up. So I think the lesson there is QuickBooks has a lot of capabilities, and they've added because they bought a bunch of other software programs over the last 2 decades, and so they have a fair amount of capabilities that people don't even realize. And so it can really handle a company up to 50 million, especially a company that might just be operating in North America, doesn't have to deal with currency and things like that, international operations that you need to consolidate in. If you're just running in North America, I would spend the time investigating what QuickBooks is capable of, besides just processing AP and receivables, because it has a lot of capabilities I don't think people are truly aware of.
And it has plugins. We used in the last company, a service company we had, security company, we used T-Sheets as the plugin for keeping track of hours because we need to have those logged. We were billing for hours, and it worked totally fine. I think most of the time, like you said, people don't understand how much it actually does. And it's worth actually, by the way, getting a consultant who actually understands it, because it will help you. It's like using Word or well, in our case, talking today, like using Excel. I wrote macros in Excel that can do things that you could code. Like people would have switched over and said, oh, well, we need to code this into a miniature software program. And you can write that stuff in Excel. So I just wanted to cover that if I got ahead of myself on this list.
No, you didn't get ahead. You did not get ahead of yourself. This is kind of a fluid conversation, right? But the one thing I'll say is that for those people who are thinking like they're outgrowing QuickBooks and they're looking at the universe of options out there, you need to spend time talking to other controllers in similar businesses and what systems they're using. Because a salesperson will tell you that this new system will solve all your problems, right? And it could theoretically, if you were staffed to excess staffing and you had all the policies in place and all the people in the business were cooperating with finance and accounting to help them get good quality information into the GL. The real world's not like that, right? You're moving fast. Typically, accounting finance might be underinvested because you're investing in the growth of the business. And so always make sure when you're making that, when you're heading towards that decision to upgrade your accounting system, you're spending the time. Once you make a decision, you need to spend time in the implementation. You need to set up your chart of accounts correctly. You need to pressure test that system and how it works against how you do things. Because 9 times out of 10, the way you are doing things are not the standard way of doing it. So if you're putting in a new accounting system and you're thinking to myself, oh, well, we do it this way, so I'm just going to customize this system to do it the way we do it, that's a recipe for disaster. What you want to be doing is saying, oh, we're doing it this way, but how do they do it in the system? And then you sort of adapt to the system, right? Because the system's based on a broad set of companies over 20 years of software development to get it to sort of standardized practices. And so if you're feeling that tension between the way you're doing things and the way this system wants to do it, chances are the way you're doing it's not right. And that system is a really good guide as to how it should be structured.
Is NetSuite the main thing that people are using at like a 50 or 100 million
Yeah,
plus?
that's what I keep running into. But I also run into the situation where, it's not being fully utilized to its capabilities, right?
NetSuite.
Yeah.
Yeah, of
Yeah.
course. I mean that I think that's the case even with QuickBooks or anything, right? But NetSuite sort of owns the market. Is that true?
NetSuite is a very big player, and NetSuite is essentially Oracle Financials, which is one of the really big ERP systems back in the day of Oracle, SAP. And there's one other I can't remember right now. Back in the early 2000s, Oracle started releasing a cloud-based offering, right? And so you basically access it through a web page, and all your accounting information's out in the cloud. It's secure, don't worry. And most of the companies that I come across in that 50 to $500 million range are typically on NetSuite. Just my experience. I don't have a vast number of experiences. That's not based on a N of 100. That's based on an N of 5 or 6 or whatever. But NetSuite's a pretty common one.
Cool. All right. Well, I think that provides some context for people out there who are wondering that. We'll get back on track with this, which is I sort of had this timed. But so, if you come into a company? What are the first steps on getting back on track that someone, a founder or CEO or the senior executive team, can expect to happen?
Yeah. So, more often than not, when I enter into these companies in this leadership role in finance, first question I ask, how long does it take to close the books? And then they give me the answer, and it's typically not at a best in class timeline. It's not in that 10 to 15 days. And so at that point, I need to know if they have a closed calendar. Well, what's a closed calendar? As we get older, I didn't have any calendars when I was a kid, right? I didn't keep track of things on the calendar, but I find it.
Didn't you have that Christmas calendar that you open each day until Christmas came?
Yeah, but I didn't even know what day it was, right? I would just pull the next piece of chocolate out, right? I think it's the Advent calendar is what they call those, Brandon.
Yeah, Advent calendar. There's also an Easter calendar, I think.
No, there might be.
Anyway, but you didn't use calendars. I didn't really use calendars other than that Advent calendar.
But as I've gotten older, life gets busy. It's really, really important. We have a family calendar. I have a work calendar. I have a personal calendar, right? And so just like life as you get older, you need to have a closed calendar in accounting. That will get you essentially from a bunch of business activity that's taking place, selling, buying, borrowing money, to a set of financial statements. And the closed calendar lays out all the steps you need to do to get you from all of that business activity that's going on around you into your ERP GL system, NetSuite we were just talking about, and into financial statements that then you can share back out with the business and tell them what's going on.
So when you say, I get it, the calendar, but the calendar, does it say on day one, whatever you make day one, right? Because day one could be day 30 or the 30th of the month or 15th of the month. However you do your day one, is day one we do receivables? Like, I'm just trying to understand that.
Yeah, and we had touched on this earlier on. A typical month-end close calendar will start 5 business days before the month actually ends. And so you need to do cutoffs on things like AP, right? You're not going to pay anyone else after a certain point. And then you have to do this thing called accruals. Accruals is the yin to the cash accounting yang, right? Accruals are, you have to estimate how much you owe someone. The invoice hasn't arrived. It's stuck at the mail office, at the post office. Most people don't even remember what a post office looks like, but we do, because we have a PO box in the little town we live in. We have to go pick up our mail, but you have to do accruals. And so you cut off AP with 5 days to go. You stop paying people, and then you accrue or estimate what you owe people for services or products that they've delivered to you or services they've rendered to you. So
that are going to come in between that 25th day and 30th day.
Yeah, or they could even come in after the month ends, right? I've committed to this, or that invoice just hasn't been received. And so you need to do accrual. So to answer the question simply, your close calendar typically will start about 5 days before. And then you will have a day by day. Each day will have a list of activities that are taking place. And then you march through that calendar. Some of these things can happen in parallel. And some of them are more serial in nature. You have to complete step A to go to step B. And so an example of a serial one would be, I need to close AR, accounts receivable. I need to close AP, accounts payable. These are called subledgers. And then those subledgers feed information up to your general ledger, which is just a summary of all the details. So you might have a lot of customer information in your accounts receivable subledger. Not all that information feeds up to the GL. The GL is just taking the numbers up for the most part.
GL is general ledger for
ledger.
Listeners.
Yeah. So that feeds just numbers and account numbers and dollar amounts up to your GL. So you got to close all those subledgers first. Then you go up to your GL. Then you might need to produce a set of financial statements for the tax department if you're making money. Companies that are making money, and the tax department will have to do it, an estimate of taxes, a tax provision, and then you put that in the books. Then you do another consolidation. You might have international currency translation has to happen in these steps. And so the point being, there are some things that have to go in sequence, and there's other things you can be doing at the same time. And so the close calendar tries to capture that from 5 days before the close, when you sort of cut off AP, all the way through to after you've closed and you're just doing account recons and other checks before you start up your next month's close.
Well, I just want to zoom out for 1 second, because when we've talked about all this accounting stuff, and we haven't necessarily, we've mentioned KPIs that the finance department would ultimately roll up to senior executives to provide direction. The other thing, though, is that taxes, Sean. When you estimate those taxes, it's a big deal, because what people will see is the P&L and not the cash flow statement, because the P&L could show that you were. This is always a trick question I ask when I teach people. I'm like, oh, well, what happens when a business is P&L positive but they go bankrupt? Why would that happen? And it happens because of cash flow, because they don't have the money. They don't have the money to actually pay. They don't have the cash. They book the cash, but it might be on 60-day receivable. They haven't, their receivables suck. And now they can't pay. Well, they can't pay their people, but you also have to pay Uncle Sam first. And you also, having been a CEO, I always make sure that happens, especially payroll taxes, because chief executive officers are liable for those taxes, even though it's a company.
Right.
So I just wanted to zoom out there to say that accounting is doing all this. The tax people, if you're making money, is estimating taxes, and that needs to roll up to your finance department who's building spreadsheets to say, do we actually have the cash? Because if not, then you might have to pull down a credit line to actually pay your taxes.
Right. And so you're sort of getting at some of the differences between cash-based accounting and accrual-based accounting or GAAP accounting. It's timing, right? I don't have that invoice in, but I need to accrue it. And you're also getting into the inner workings of the income statement, cash flow, and balance sheet. Let me give you a simple example.
I'm doing that on purpose, because I think people need to understand. Like, even some senior executives don't understand that in big companies.
Right. So let's give you an example. So let's say you have to buy some equipment, $1 million piece of equipment. You're going to pay $1 million cash for that, right? When you buy that piece of equipment, you may finance that, but let's stick with a simple example. You're buying $1 million piece of equipment. $1 million of cash goes out your door. What's going to appear on your P&L or your income statement is really nothing that first day. Let's say you bought it the last day of the month. There's going to be no activity representing that cash outflow on your income statement because you haven't put it into service. You haven't started depreciating it. Now, if it was a year later, we would see depreciation on that equipment go through your income statement. But that's not cash. That depreciation is just burning down the value you paid, right? And so there's a perfect example of something that's on your income statement that looks like maybe a year after you bought it that you're spending cash, but you're really not. You spent the cash a year ago. And if you spent that cash on the last day of the month and put it into service that day, you wouldn't really even know you had that asset looking at the income statement because there'd be no depreciation showing yet. That depreciation doesn't start till the first day of the next month, right? Or the day after you put it in service. So that's an example of why it's so important to have a fully integrated income statement, cash flow, and balance sheet. Where that asset will appear, the cash will appear on your cash flow statement. In the investing section, you'll see capital expenditures typically aligned there, and it will be a negative cash outflow. It will also appear on your balance sheet. That asset, once it's put in service, will appear as an asset on your balance sheet, and as will the accumulated depreciation for that asset. And it'll end up having, if you take the price you bought it at, the $1 million, let's say you depreciated 500,000, you've had it in service for a while. The net asset value on your balance sheet would be $500,000, and you will have run by that time $500,000 of depreciation through your income statement. And so you're getting a little bit into the sort of inner workings of those financial statements. It's really important stuff. That's the hardest part of accounting. It's something when I used to hire people, I had a little case study that I gave them an income statement and a balance sheet. I made them fill in just a couple blanks on a cash flow statement because I kind of view the cash flow statement as the thing that ties those two together. And so I would test them by seeing if they could pull the right number from the income statement in the cash flow, or pull the right number from the balance sheet in the cash flow, and then it would all work. And if it all works, it essentially means the ending cash, your cash flow statement is the same cash that's on your balance sheet. And that's how it all sort of ties together.
I know that was in the weeds for listeners, but I think it was worth covering because it goes to show how the accounting and finance work together, and how if you do not have in your company someone who represents both parts of that, you can find yourself in real trouble.
Yeah, and you also touched on tax, right? We didn't get too much into that, but yeah, you got to have yourself buttoned up when it comes to tax. You said the CEO is liable. It's all the officers of the company that are liable if you're not paying taxes. The payroll tax.
I was just being selfish because I wasn't all those people.
The payroll taxes, certainly ADP or payroll provider helps you figure all that out. But
even they sometimes don't get it exactly right. And then next month you get the thing from the Uncle Sam and you've got to reconcile it.
Yeah. And you'll get audited, right? If you're a profitable company, tax auditors from your state, from the government, from other states where you do business, they're going to come and audit you and make sure you're paying your fair share of taxes. So I always say, there's a couple of things where I say you overpay for talent. You overpay for your controller, right? So you have a CFO and then you have a controller. I would always overpay for a high quality controller. Someone who has maybe experience at one of the big four accounting firms, maybe they've been at a public company already. I overpay for that talent because they are so critical. And then, I'm not saying overpay for your tax service, but just make sure you're paying someone to cover your butt on this tax exposure, because especially if you're making money as a company, because it could be, you don't want to end up in jail.
No, and they do. And I'll just say, I mean, we haven't run $100 million company yet, but even at the smaller numbers, they send the stuff in the mail, it winds up on my desk, and it is not worth, unless you are absolutely sure and you're like at some very large number, fighting, because by the time you reconcile it, you already have penalties. So, we've always said, just pay it. And sometimes they'll come back and say, we made the mistake, and then we get money back, which is a county nightmare, but better to do that than not pay and wind up in trouble. So I don't want to go down that rabbit hole. But
so let's go 1 second back to just like your staffing levels, like 100 to 500 million in revenue, and you're profitable. You should have 1, 2, 3 people in tax. Also depends on what type of entity you are, C Corp, an LLC. That the LLCs can make things more complicated. But yeah, if you're profitable and 100 million to 500 million, you should have 2, 3 people in tax. I think at Dolby we had 5 or 6 in tax, and you still outsource, right? Even Dolby would outsource its tax provision work, right, which is more around the income taxes here in the U.S. So It's very complicated. I think companies below 100 million in revenue probably don't need a tax specialist. I think you just outsource it to someone reliable. A lot of good firms out there that handle that work, who do it for a lot of companies, and they also stay on top of new guidance, new rules, new regulations, new laws. That's the other thing. Like, you're a busy controller at a company, you're thinking about a million things. The last thing you need to be is caught off guard by like a new law that's been released about state tax apportionment, or who knows what it could be. So it really pays, I think, to have someone reliable covering that part of your exposed area.
I don't disagree. I read the Noah book every year, but that's still like, that's not even close to the weeds. So let's keep going. Another question I had is people. We've talked about people, but let's directly address it. How do what role do they really play in what you call is, I call high percentage tips. You call closes, high quality closes.
Yeah, I mean, listen, you need different types of people at different stages of a company, right? And you don't want a payroll specialist doing your accounts receivable work. It's just, it might be different muscles that they don't have. I'm a big believer in giving people opportunities. So sure, if I have someone who's been doing payroll for 10 years and they do a really good job, I'm going to try to train them on something else and help them grow and develop their career. But the point being, there are specific skills and experiences you need within the accounting organization to be successful at that specific accounting job. And sometimes, as you grow, you're going to want a leader of that sort of sub function within accounting. So whether that's payroll, or accounts receivable, or revenue recognition, right? You're going to want a leader of that organization who has a lot of experience and credibility. But and the other thing I'll say about people is, like, as your business grows, you see this all the time, not only in accounting, but even in leadership and other parts of the organization, and research and development. The people you have at 50 million or 5 million of revenue are probably not going to be the people that you need when you're 500 million or $1 billion in revenue, or you're a public company. It takes a different sort of skill set, a different set of experiences, a different sensibility to be a public company than it does to be a small startup, right? And so I always just, I try to give people opportunities to grow with the business. I think that's really important. That's how you build a high quality team, high functioning team. But it doesn't always work out that way, right? Sometimes the business outgrows the people. And that goes not only in accounting. Like I said, it can go in finance leadership. You might start with a VP of finance, and then you outgrow that and you want a CFO, but it might be a first time CFO, right? And then you want to be public. You want a experienced public company CFO to be your CFO, who's dealt with investors and all the vagaries of public markets. So it's in any role. How can that person scale with the business? I will always give them an opportunity to try, but if it doesn't work out, that's okay. And you find someone who can take that next step with the business.
And I actually think it also works the other way, because I haven't been on that bit. Well, I worked at America Online. I think we had 7 billion in revenue. I forget. But on the lower side, to your point about finding the right people, not all big company people should go join a startup, because startup is a total cluster of creativity, complete chaos,
no guardrails.
like there's no
rules.
systems and processes.
Right.
And I've made the mistake about 150 times of hiring, not in finance, but a VP of sales, when the VP of sales couldn't execute, not because they weren't a good VP of sales. I hired a person out of one of the top CRM companies in the world, but we didn't have a repeatable sales process. So he couldn't, that's not his specialty. His specialty is taking a process and scaling it to building a team. So I'm only mentioning that for small companies who are listening, because you can make that mistake. It's not good or bad. It's just people have different skill sets. So sometimes you bring in, and a lot of corporate people who have in these companies that have a lot of money are used to spending a lot of money. And sometimes in the startup, you don't have that. So it goes both ways. And I know you've seen it both. You've seen that story play out, right?
Yeah, no, there again, some people love working at startups, and they'll just go from startup to startup, right?
No, right. And stay in that 1 to whatever 25 million lane, like, cause it's chaos.
But they love it. Right.
Yeah. I wouldn't want to do the bigger stuff, to be honest with you. It sounds boring. I'm I know not as much as you do, of course, but I know a lot of the details of this stuff, and it just kills me. Like I just can't even imagine in the minutia, right? I mean, and if you interpret, I know we keep harping on taxes, but it is be tax season soon. Is if you get one of those tax things wrong, it's a big deal.
Yeah.
I mean,
well, let's also accept, Brandon, that accounting is not perfect. So we haven't touched on this, but we have what we call reclasses in accounting and missed accruals and all sorts of,
notations, right? What are they called?
well,
I mean, vet makes them a lot because I will mischaracterize something. What adjustments?
adjustments. Yeah, right. And so um, the first time through a close, whether that's a monthly close, quarterly close, annual close, you're not going to capture everything. If you're a big public company like Dolby, you actually have a list, and there's guidance around this of things that you missed, that either you have identified or your auditors identified, and then you decide whether they're material enough to actually book back into the period, or you just book them into a subsequent period. So this is definitely a science, but there's especially in the earlier stage companies, it's an art, and it's humans doing it, right? And until I guess ChatGPT starts closing books, it's humans, and humans make mistakes. And so the accounting gap system is set up to almost acknowledge that things will happen, because then you have adjustments either to the prior period or into future periods. You have reclasses. Let's say I booked an expense into your department, but it was actually for Janet's department. And so Janet doesn't want to see that in her budget versus actual report. It shows her as being over on travel, and she never travels. And it's because I booked Brandon's nice, expensive hotel that he likes to stay at on her into her department. And so next month we wouldn't go back into the month we just closed. You don't want to do that. Once it's closed, you want to just sort of move on to the extent you can. The auditors will allow you to move on. Um, but we'll go back next month and we'll move that $10,000 hotel stay that Brandon did out of Janet's budget over to Brandon's.
Well, you can barely get me to buy a new bike, so the $10,000 stay probably be nice for somebody. But yeah, so I think that's a good point. That it is as much of an art as it is a science, and it's not. I don't want to say it's allowed, but it's expected that things are going to get screwed up, so at some level.
Yeah, as long as it's not purposeful, right? Then you can get yourself in jail. But
yeah, right. I mean, as long as it happens, like you said, or something gets missed, or you estimated that service on an accrual at the end of the month that turned out to be 10 times as much, but you weren't aware because there was some miscommunication or something happened,
or no one told you.
Right.
It's been running 10,000 a month for the last 3 years. You don't have the invoice from the law firm, so you accrue $10,000 because that's what it's been running. And all of a sudden, your lawyer shows up and goes, "Oh, here, I got this invoice. We just, did an acquisition, and this firm advised us on that acquisition. It was top secret inside the company. No one knew about it except a small team. Certainly not this person in accounting who's doing the accrual." And all of a sudden, 10,000 a month turns into 400,000 in a month, right? And so this is just, things happen like this. And so you try to put in policies and procedures to prevent that from happening. You try to have someone talk to the business. What's going on? I don't need to know the details, but I need to know, like, are you running this bill up, 10x what it is normally, right? And so once you have sort of robust staffing levels, and you build that connection between finance and accounting and the business, and you're serving them, the information flows much better, right, and much more freely, and you have the resources to do that, to do those double checks to make sure there's no surprises.
And it's going to happen. Like, you think of a company with 1,000, 2,000, 5,000, 100,000 people, like, this is going to happen. Let's talk about audits. You talk a little bit about what is an audit, because you hear the word, I mean, a lot. And are all audit firms the same when you start to evaluate who you're going to have do that?
An audit is a process by which someone comes in and sort of checks your numbers, to put it in very basic language. In the world of accounting, there's also tax audits, IRS audits for individuals, right? There's all sorts of audits. Audits, people perceive that as a bad word, and if you're not buttoned up, it could be a bad experience for you. If you're buttoned up pretty well, it's no big deal. But what you do is, as opposed to, say, an individual IRS tax audit where they just come looking, thinking you might have underpaid your taxes, in a company, you hire an audit firm, and they have an established reputation. They give an opinion on whether your financial statements are represented accurately and in completely the goings on of your business. And so they give an opinion. But in order to give that opinion, there's a lot of work, and they come in and they want to check to make sure all the revenue transactions are real. They want to check, make sure you didn't miss any expenses. They didn't overstate the value of any assets. That you're basically following GAAP accounting principles as you should. And as we talked about earlier, there's going to be some gray areas, and they might find something, and you may have realized that it was a gray area. Maybe you wrote a white paper up, and you hand them that white paper and say, "Here's the position I took on this item." And they're going to review that, and they're going to have their own opinion, right? They're checking your account recons, like what was your opening balance, what was the activity, what was your closing balance? Did someone build that recon, or did someone review that recon? Every month, right? You're supposed to have those recons in place. So that's what the auditors do. A financial statement audit can take 3-6 months, depending on how organized you are, depending on how much of this policy, process, system, people you have dialed in. Those all play into it. We're here talking about small companies mostly, right? Trying to provide some information. There's all sorts of types of auditing firms. There's auditing firms at the local level. There's auditing firms at the regional level here in the U.S., and then there's national firms. And so each one will be more intense, have higher levels of scrutiny as you go up from a local to a regional to a national firm. The other thing is that there's two types of audits, Brandon. So one's called a AICPA audit. I don't know what the acronym is, but I know it's AICPA. That's what private companies do. That's the audit standards under which they're audited. If you want to be a public company, you have to do what's called a PCAOB audit. That
every year.
Every year. That audit is going to be have lower materiality thresholds. They are going to expect you to have a robust internal control environment. SOX, Sarbanes-Oxley, I don't know if people have heard of that, the law that was established back after the dot-com bubble to make sure people have a robust internal control environment so that things can't go wrong.
Especially around options.
All sorts of things. And so a PCAO audit looks at your financial statements and looks at your internal control environment. If you're going to go public, you need 2 years of PCAOB level audits on the 2 most recent years. And then once you're public, you're just on PCAOB. They're more expensive, they're more detailed, they're more time consuming. And if you don't have your house in order, they're immensely more painful. And so, the moral of the story here being, it all starts with people, process, and systems. Try to get your house in order. Bring on an auditor. Auditors provide you credibility. When they issue an audit opinion, some people call it a clean audit opinion, right? When you get a clean audit opinion, those financial statements help you in a number of ways, right? If you're trying to sell your business, it adds a lot of credibility to your numbers. People trust that if you have an audit opinion that they're not made up. It allows you to get loans, right? Banks don't want to make loans to companies that don't have audits. They do in certain cases. Silicon Valley Bank might have done a fair amount of that, and that's not why they got in trouble. But the point being, audits add a lot of value to sort of what you're trying to do as a business, whether it's get a loan, sell the business. So I think, you want to get into your first audit. If you're in the multiple million, let's say 5 million and above, you should be thinking about a local audit firm.
That's fair. The next one, which I think we've covered a little bit, but I still want to make sure that we do cover it, is where do you invest in a small business when it comes to accounting? We talked about the people, and we've actually covered people, we've covered software. Is there anything else that you remember we may have missed on this topic? I mean, the one thing that I know that what we talked about is having a controller. You said you overpay for the controller.
Yeah. I mean, that again, let's start with it's people, process, and systems, right? And that's in order for a reason. If you don't have good quality people, it's not going to matter in accounting. So a controller is the leader of that team. if you're, like I said, we talked at the very beginning of this, if you're a controller, you could be also a chief accounting officer, which is like a real SEC recognized title, when you're SEC being not the Southeastern Conference, the Securities and Exchange Commission, when you're a public company. So you want to make sure your controller is top notch. Starts with people. From there, no matter what system you put in, if you don't have the processes and policies in place to govern the flow of information, the way people behave and spend money on behalf of the company, if you don't have all of that in order, um, it doesn't matter what system you have. So it starts with the people, in my mind, building a team that trusts one another, a team that helps one another out, and that controller is the lead of that team. And like I said a number of times now, I that's where I would spend overpay for your controller.
The controller, as if we think of the progression of a company, is probably going to come before the CFO.
For sure, for sure. It is probably pretty much the first accounting hire you probably start with a bookkeeper in a really small business, but you very quickly should get to a controller who has, might have a CPA. A bookkeeper might not even have a CPA in some cases, right? They might just be in QuickBooks processing AP and payroll, real simple business activity. But yeah, controller is a pretty early hire.
What do you think it, as someone who, as a CFO in a company, is the most critical thing to understand about accounting?
I don't know if we talked about this before we hopped on the podcast here, but I think we did talk about it on the podcast. I believe in sort of having, as a CFO, specific knowledge on critical accounting matters in a company. So every company is different, right? Different types of business. You have direct to consumer online businesses. You have software businesses that sell to other businesses. You have software that sells to consumers. You have construction businesses.
E-commerce.
Yeah. I said online. Yeah.
Yeah. I just,
Yeah.
online now, you have like media businesses, you could be an influencer, but I'm mentioning e-commerce on purpose. One is because you've been at an e-commerce company.
Right.
And two is e-commerce companies have a load of different
attributes and
issues.
Yeah.
I mean, from payment processing to inventory to holdbacks on credit card payments, which people never remember happens. I mean, it happened to us on a small scale. I mean, hundreds of thousands of dollars. So that's why I mentioned it. There's a lot of e-commerce people out there now.
Yeah. And so they call these critical accounting matters, right? As a CFO or a finance leader, you need to understand your company's critical accounting matters. For me, at one company, that was revenue recognition. At another company, it was inventory. And it could be, if it's a project, let's say it's a big construction company, maybe it's project management accounting, right? That's a very different piece of the accounting guidance and world. So you need to understand your CAMs, or critical accounting matters, as a finance leader, because you need to be really well educated, not only on the GAAP guidance, but how your company's applying it to your day-to-day accounting and operations. So that's where I typically start, is what are the major things. And in e-commerce, like you said, it was inventory was a big one, right? But in a software company selling to other businesses, it's revenue recognition, because you might sell a product and promise a customer that you're going to deliver some additional features or functionality down the road. Well, you can't recognize all that revenue until you've delivered all those other elements. So the rules have gotten a lot better for that type of situation. It used to be you had to defer the whole sale until you delivered those pieces, or it was very hard to recognize much of the revenue. In today's world, and with updates to the accounting guidance, when you do that sale, you just have to carve out a little piece that represents the value of that future feature or functionality. So again, you have to understand your business. And so for any leader, it starts with a listening tour, right? Not a talking tour, a listening tour to understand from all parts of the business, every function, what's going on, what do you do, how do you do it? And then you come back to your accounting team, and you have some thoughts on what might be critical areas where we could get tripped up. And those are your critical accounting matters. And those are high on the radar for your auditors too.
Next one on my list was talking about, which I clearly jumped ahead, which I sometimes do, which was what software to use. We talked about ERP systems. We talked about NetSuite and QuickBooks, and we went through, actually, I think everything that I had a question here on revenue and things like that. I don't think we missed anything along those lines, did we? I don't think so.
I don't think so.
I mean, it's pretty clear just uh, for listeners. Again, I had this list, so I wanted to make sure that we covered it all. But basically, Sean, you said QuickBooks up to 50 million. After that, you're probably going to go to something like NetSuite, but there are other options, and try to go as long as you can, because when you do the implementation, it's actually going to cause you're going to need more resources to do the implementation, because an implementation can take 6 months to a year, can it?
Oh, easy. And again, 9 times out of 10, I show up someplace that's on that next stage ERP system that they've implemented, and the first thing they start telling me is all the problems and all the things that aren't working and all the modules of that software we haven't turned on because we don't have processes to support that, and so forth and so on. So yeah, um, up to that $50 million range, you're better off spending time understanding the true capabilities of something like QuickBooks than you are investing time and energy thinking about what that next step is, because there is, like I said, a lot of things that people don't. It's way underutilized, QuickBooks, from what I've seen in my experience.
Control environment.
Yeah, we
What does
touched
that
on this.
mean?
Yeah, as you grow and add more resources, you start thinking about things like segregation of duties, right? You can't have someone, collecting cash from customers being the same person who's paying money out, right? Because there could be, a little funny business going on. So we need people to have roles, and we need people to have security around those roles. Like, can Sean, as the CFO, go into our financial accounting system and book an entry? That doesn't seem like a good idea, right? Or can someone from sales go into our our systems and book an entry? Doesn't seem like a great idea, right? So a control environment are processes, policies, checks that are put in place to make sure that we're following the rules generally, right? That there's no uh, activities taking place that are unusual, or try to prevent that from happening. And so your internal control environment and documentation of that environment are really important things to have in place as you grow as a company. It's not something you need to worry about when you're a startup. But when you're thinking about being a public company, and I said that PCAOB audit might be around the corner, you want to start investing in understanding what that internal control environment needs to look like. Um, Companies that go public, depending on their size, actually have time to be SOX compliant after they go public. And so there's some exclusions that have been put in place in more recent years to sort of rationalize the original Sarbanes-Oxley rules. And so you have time. It's not a topic that you want to spend a ton of time on when you're a small enterprise. You certainly want to, make sure you have segregation of duties, and you have people doing reviews and sign off of account recons. Like, again, you are in charge of accounts receivable. You start with an opening balance, Brandon. You list out all the activity that happened in accounts receivable in the month, and then you have a closing balance, and that goes on the balance sheet. I then take that and I review that, and I tick and tie it. I think you were mentioning Yvette, right? She ticks and ties things, right? And so I just make sure that looks good, and then I put my signature on there because I'm the reviewer. That's a good control around account reconciliations. In companies, not necessarily in QuickBooks, that probably has the functionality, but most people don't have it turned on. You can propose an entry, Brandon, as an accountant, but me as the controller might want to approve that entry, or one of my managers approves an entry of someone who proposes an entry into the general ledger, into the accounting system. That's a good control. You just don't want people to be able to put things in there, even if they're on your accounting team, right? You want to have checks and balances. So a control environment's all about those checks and balances. It can't be too early to start thinking about some elements of it, like I just discussed. But like, if you're thinking about being Sarbanes-Oxley compliant, that can wait a while. That can wait, probably past the $50 million mark before you even start thinking about that.
I had a question for you, and it was right on the tip of my tongue, but I didn't want to interrupt you. The Sarbanes-Oxley, though. Speaking of that, I understand you don't want to be compliant, but at the same token, you don't want to. You do want to have some awareness of it, because you don't want to be breaking it for 10 years, go public, and then say, "Oh, we fixed it," because no one's going to believe you.
Yeah.
Right? I mean, I'm just providing a little guidance and saying you can't be reckless about it. You may not need to be exactly compliant, but you do need to comply for the most part along the way.
Yeah. And listen, there are firms out there that will get you Sarbanes-Oxley ready, whether, to be a public company or if you're being acquired by a public company, you can bring them in and they can very quickly get you into shape. And so there's resources out there. But to my earlier point, you don't need to be Sarbanes-Oxley compliant as a smaller enterprise, small, medium business. You just need to be aware of things like, I shouldn't allow anyone and their mother to put things into my accounting system. I should have people review work, account recons that are done. Because when your auditors show up, they're, forget about SOX. They're going to want to see those account recons and those journal entry approvals in place to make sure that you have something that they're going to put their name on and say that this company is operating and producing financial statements they think accurately represent what's going on in this business. If you don't have any of that basic control environment elements, it's going to be that audit's going to be a long audit, a lot of work, a lot of fees to get you to that audit opinion that you want.
Well, I just want to say one thing around that. I remembered what I was going to ask, and just to make sure that we're clarified on this. When we talk about all these policies and procedures and control things, we really are talking about that these things are written down on a piece of paper, online or in a binder, that actually spells it out. And I know that's incredibly painful for some people listening to hear right now, but it's not just like, oh, what you just said, Sean, is, oh, hey, we're not going to allow salespeople to put an entry in. And that's sort of what we talk. This is written down in a policy that someone in finance and accounting eventually is building these documents along the way.
Yeah.
I just think it's worth mentioning this.
Yeah, it's written down, and there's a lot of examples out there. So luckily, you won't be penalized for getting your hands on, either from a firm you outsource to or from a friend in another company, getting your hands on some of their SOX documentation, because it's not like you need to reinvent the wheel. 80% of that documentation is general in nature and applies to any company. So you don't have to start from zero, is my point. Yes, it needs to be documented. But here's the other thing, Brandon, and I see this all the time. People document it, put it in a binder, put it on the shelf, whatever, save it on a drive somewhere. They never revisit it. And then as time goes on, the owners of those controls lose sight, or they go to another company, or they retire. All right. And so you can do all this work to document everything and you're good for day one. But day two, the next day, if those owners aren't aware that they're owners of those controls and they need to execute those controls on a monthly or quarterly basis, it's all for naught. So you have to stay on top of sort of education, awareness. Sometimes these controls definitely can touch outside the accounting organization, right? And impact people outside the accounting organization. Again, where they have turnover and retirements and all this, changes of roles, people get promoted. So yes, you need to document it. That's how you can share information very easily when it's documented. But you also need to make sure these controls have owners, that they have people who are reviewing them. There's a team at some public companies called internal audit. They make sure that the policies and processes of the company are working properly throughout the year. They just don't show up once a year like an auditor does. And the internal audit team will be looking at how things are working, what the compliance level is within the company with regard to policies and processes. So that's a topic for another day. But just saying, you need to have ownership of controls to make them truly successful.
Which is probably a whole nother topic for another podcast, because education and continuing education, which most people roll their eyes at, including me sometimes, is if you don't have that, then you don't have, and no one knows about the stupid thing in the binder, it just doesn't matter. But that's like a whole nother level that you have to do on your finance and accounting team.
Yeah.
This educational or review every quarter, like, hey, remember this policy, go over it.
Yeah, at Dolby, we had a great CFO and a great controller, Ryan. And Ryan had a program called Striving for Excellence. And he would have quarterly meetings with the global accounting organization, and they would cover topics in the spirit of a continuing education. And so, that's what leaders do, right? Leaders help remind people of why we're here. They help people learn and develop themselves. And so, highly, no matter what area of a business you're in as a leader, you have to be open to not only your team's growth and development, but also your own, right? Like I don't know what point in my career, but at some point I switched from sort of seeing some of this continuing education or learning as a burden to a real opportunity, right? Because I saw leaders who would just be briefed on a very complex topic, right? But they would pull away two or three key elements on that topic, and then they would go to a different audience and they would repeat those two or three elements, and you would think they were working in that field their whole life, that they were a specialist. It's really a great art form, to try to be open to a growth mindset, be open to learning as a leader, and then trying to capture those key elements and become, in a way, a little bit of a subject matter expert yourself on that topic. So
I think that's just getting really good at your craft.
yeah,
And when you know it so good that you're like, oh, okay, Sean, I need to know these three things. Well, once you're good at it, you can very, very quickly put that together in your head, how it fits into these other pieces, which actually makes you sound very intelligent, but you understand how the inner workings relate to the bigger business.
yeah, but you don't have to know everything, right? You
No,
just have
that's what I'm saying. But you just have to know how it relates.
yes,
And you talk about all this other stuff, and they're like, holy crap. Well, it's really just being excellent at that craft of knowing how to take this data in.
right. I mean, very often at Dolby, I'd be like, I could answer level 1, 2, and 3 on RevRec. But when I got to level 4, we had an amazing assistant control over there who also covered RevRec, and she was the best I've ever seen on the topic. Once I got to level 4, I'd be like, I need to hand you off to this person, because this is a little too deep for me. But having those first 3 levels of knowledge give you credibility, also help you sort of triage and get through questions that the business has pretty quickly. So you don't have to sort of burden more resources within the finance and accounting organization to help the business, So again, I'm just really encouraging. I didn't all the stuff we're talking about today, I'm still learning some of these things, right? From different experience and different companies I end up at. If you want to be a great leader, whether it's in finance, accounting, or another part of a company, you got to have a growth mindset. You got to be willing to learn. It never stops happening. The learning never stops.
Yeah, I think I add on to that, Sean, and say that one of the things that I tell people is if I'm the smartest guy in the room, we are all in trouble. I mean, period. Like if I'm the smartest guy in the room in those verticals, we're in a lot of trouble. And what you're describing around growth mindset, I would reframe in my words and say, you've got to be comfortable in yourself. Because if there's any, like, we're talking about one silo in a business today, a really important one, because it comes to money. And without that, all the rah rah and whatever doesn't matter. But this is one part where you actually need to be comfortable with yourself because you need to hire people who are smarter than you. And if you have a CFO who doesn't want to hire someone who's smarter than him or her in tax recognition, there's no way that a CFO can know everything. So when you say that, I just emphasize that, like, you, especially as you start to scale, you need people who are smarter than you. And that, I think that is a way of saying you're in that growth mindset, right? Like you got to, this isn't an ego thing. This is, you need people, like you say. I said one time in a meeting, I, I was doing a presentation and someone said, well, ask me a direct question. I was like, I don't even know the answer to that. And I brought a junior guy in, and the person pulled me aside afterwards and they're like, I've never seen someone do that. And I was like, well, why would I answer a question that I don't know? Like, I'm not scared to say that this person knows more. And I think in finance and accounting, as we've talked through this, if we reflect back on the last so far hour and 20 minutes here, you've got to have that, right? I mean, if you if you walked into a financial, which I'm going to ask you in a second, but we're going to talk about outsourcing because a lot of people aren't going to be able to hire a full-time person for these things. But if you walk into an organization and you find a man or a woman who wants to be the smartest person and needs to be because of that trait, then that's a red flag, wouldn't you say?
Yeah, and again, this is all about maturity, right? Being comfortable with yourself. I think that's where you started off your comments. I more often now in my career, I will say, I don't have an answer. Let me get back to you, right? Whether that's with a board or another executive. And that's because I can't have all those answers and then be effective as a leader trying to help other parts of this company achieve their goals, right? If I'm going to be deep and dark in revenue recognition, and that's all I'm focusing on all day, how am I of value to the R&D organization or the CEO who's trying to think about a shift in strategy at this company? Again, it's helpful to have some level of broad-based knowledge in finance and accounting, but it all comes down to time and how you allocate that time and mind share. And another thing you touched on, which I think as a leader is really important, is don't be afraid to bring people on your team into those situations. If it's just to sit there and watch as a starting point, but maybe as you said in your example, Brandon, it's because they have the answers. Uh, God, I can't tell you how many times I was given that shot or not given that shot. And it's really meaningful to give people those exposure moments to whether it's the board or the executive leadership team, or maybe to a customer, to give people on your team those chances to really show what they're capable of and let them develop their own professional skills and executive presence and all this stuff. So, yeah, it's funny how we go through this conversation. We say little tidbits, and it's like, oh, that's like a leadership tidbit, and let's make sure we emphasize that because we're here to talk about finance and accounting. But to be successful in finance and accounting as a CFO, you need to be successful as a leader too.
Well, and every single person in your organization, if they are scared to have someone smarter than them when they need to be smarter than them, like it's a recipe for disaster. And when it comes to money, there's like, I don't want any disasters.
Yeah, I would rather. I always said this for people on my team. I try to hire people that are smarter than me, that make me look good, and then my ultimate goal, because I believe in myself and I'm self aware to a degree, and I know what I'm capable of. But my ultimate goal is to have someone who is below me go past me. Right? They can get my job or the job above me, and go for it. Right? That's how I want to build a team of people who want not only my job but my boss's job. And if they get that job, that's awesome because I know they made me look good along the way. And I don't mind working for really talented, smart people.
I just read an article the other day, and then we're going to talk about outsourcing that it was in Entrepreneur Magazine, actually, or Inc. Magazine. I can't remember which one, but there's a company called Cart.com, which is basically doing a fully integrated system for e-commerce, including fulfillment. So it's not like a site that you just manage your online stuff. It's almost a deeper Amazon because Amazon sort of does have that,
Yeah.
but not at the level of your own shop because you're a mini shop within Amazon. This
Right.
is like Shopify on steroids called Cart.com. I have no stock in them. I just read this article, but he was this gentleman who became a partner in it and is a senior person there, and his name escapes me. He had a really interesting story because he almost got killed literally he came here, I think, from Turkey or somewhere. Anyway, he got kidnapped and they didn't have the bullets in the gun actually didn't go off, if you can believe this. But he said I think he interviewed for that position or for the job, and the guy asked him, he said, well, what do you want to be in 10 years? And he said, I want your job. And he's like, you're hired. So that's the type of people you're generally looking for
Yep.
In general. So let's talk about outsourcing. I know we went down a rabbit hole, but sometimes we do that here. But it is that's like vitally important anyway, and it applies to all things in a business, but especially in finance. What about outsourcing?
It's a critical way to cost effectively scale your finance and accounting organization. Um, Certainly, I see more outsourcing on the accounting side than on the finance side, but some people do outsource their finance FP&A. It happens. But on the accounting side,
FP&A is what?
financial planning and analysis,
Okay.
sort of like the core of the finance half of finance and accounting. Um, so I see a ton of outsourcing in companies, all the way from $1 million, $2 million of revenue, all the way up to billions of dollars of revenue, and that's because typically other companies specialize in one area and they can get their own scale and high levels of profitability from doing that for lots of companies. So a lot of the back office accounting, including accounts payable, accounts receivable, your tax provision work, your financial statement preparation for audits, and footnote preparation for audits, SOX work, all of this work is being outsourced by companies in the US. It can be onshored, it could be offshored. Onshored meaning somewhere in the US, offshored mean somewhere outside the US. But I see it everywhere, and it's a great way to cost effectively scale your capabilities in finance and accounting that you couldn't do with full time headcount, stationed in a high cost area like we are here in the Bay Area. So if you're not outsourcing today, you should be thinking about it.
All right, I want to do as we start to wrap up, I have two more things to talk about. One of them's sort of selfish, but let's do a real world scenario, just do a case study real quick. You go into a company, you've actually done this, and I think it would be good for a CEO who's listening, a founder, senior leadership who may be looking for a CFO out there for that position, whether they're going from controller to CFO or they're looking for another CFO. You walk into a company, it doesn't matter the size. What's your first move?
Besides going on a listening tour, and that's a little of a personal thing, right? Because I tend not to be a great listener. So I would start with a listening tour across the leadership of the company. But the first thing I want to see as a finance leader is I want to see the financial statements, right? Show me your income statement, your balance sheet, and your cash flow. I've been to places where they're like, yeah, we don't quite have a cash flow that's working. We sort of manually pull it together sometimes when we need it. So I want to see those three financial statements.
Sometimes when you need it, like every single day to understand your cash, to how much money you have. Anyway, I'm joking, but
yeah. So I want to see those financial statements. And I touched on this a long time ago in our conversation today, but I want to make sure that the ending cash at the bottom of the cash flow statement is the same cash number that's at the top of the balance sheet on the asset side of the balance sheet. So make sure that those statements not only are being published, but they actually are tying to one another. Once I get those financial statements, I asked the controller, we touched on this a lot throughout today's conversation, how long does it take to close the books? That answer typically ranges from 10 to 25 days. 10 days, well, there's maybe not a ton of work we have to do to get to a really good place. But if it's 25 days, which I hear often and hear about friends who are in the world of finance.
You've heard longer though, because we've talked about it on rides before, right? You've seen 45 days.
Well, yeah, I mean that's an absolute disaster, right?
I know. I'm just saying though, it's a reality.
Yeah, that would be bad. But I mean, typically it's in that 15 to 25 range. So there's still some wood to chop. So I want to know, I'm going to sit down with the controller then. Remember, I said the controller is the key person. I'm going to sit down with them and I'm going to want to understand all of the gating items that are preventing him from having a 10-day close. And that list is going to be organized along people, process, and systems, the three things we started this conversation talking about. And I want to know not only the things within our team, but what are the cross-functional gating items? Because then I have to go on a goodwill tour around the company and try to build relationships and connections with other leaders and try to convince them that it's really important that they dedicate some people from their team to help us count inventory every month, or that they track inventory movements within the company. Those are not my people doing that. That's people in supply chain or operations, right? And so I have to reach across the aisle, to use a political reference, and get them to buy into why we need more structure, more process, more ownership around some of these activities, because my people don't do that. My people on my team don't perform those activities. They're not on the warehouse floor. And so I need to go figure out what the gating items within our organization, what they are cross functionally. And I got to sort of work the phones, kiss the babies, try to make friends, try to learn also while I'm doing all that. Learn why we haven't been able to do this in the past. Is it a resource problem? Is it a systems problem? Sort of approaching everything from multiple angles to make sure I get the whole story. Because what you'll find is you get one story from accounting, you get the opposite story from people out in the business, and the truth lies somewhere in the middle, right? And everyone's busy and everyone's trying to do what's best for this company, but sometimes those interests don't align, and most often they don't. So I'm trying to convince people that it's worth our time to sort of invest in those areas where we cross over. The only other thing I'll say is accounting. Accounting likely can't fix a slow or broken close process on their own, right? Like I said, it will take engagement from other parts of the business. And the other thing I'll say, which I run into this, is leadership sometimes wants someone like myself with a ton of experience to come in here and fix everything tomorrow. These things don't fix in a matter of days or weeks.
Why not?
Because
I'm just joking. First thing, you can't undo that.
No, it's a good question. But first thing is you close your books monthly, right? So like if I change something this month, I won't know if it worked until 15 to 25 days after the month's over. And if you're talking about a system implementation, we're on a year's journey together. And so we need we need alignment and buy-in cross-functionally when you're undertaking a big project like improving accounting close and implementing systems. But you also need time, because time allows you to be thoughtful, allows you to bring in subject matter experts, gives you time to think about how you set up your accounts, to enable reporting. And if you rush this stuff, you put in crap, you get out crap. And so, just for all those leaders out there, just understanding that, a good accounting close is not built in a matter of days, weeks, or months. It's built over a course of a year, maybe longer, especially in a fast growing business.
Well, what was I going to say? The other thing along those lines, which I just emphasize is to emphasize is that you come in there, you're a new person, you need the support of these other people. They may not have been providing support to finance before, so now they look at you as a time suck.
Yeah.
And they don't really directly see benefit immediately until you can even collect that stuff and potentially provide KPIs to them that they weren't getting before. So they don't see your value. They just see you as like a sucker, time suck. So it takes a minute to get this aligned, and culturally, right?
Yeah.
I mean, I'm only emphasizing this because I've seen it before. I brought someone in for not necessarily finance, although I have been a finance guy at a smaller company, and basically got my rear kicked for a few months, as I'm sure you have, because they're like, well, why are we doing this? We do it this way. We do it in an Excel spreadsheet. And I'm like, we can't do it in an Excel spreadsheet. If we're going to get bigger, we're going to make a mistake. And then it like takes a minute, because there's this thing called humans involved to get buy-in.
Yeah. Yeah. So this doesn't begin, you want to fail as a leader. You go in and you try and do things the way you've done it at other places. You try to jam systems in that people aren't bought into. You try to jam policies in, or processes into reality where you don't have buy-in and support from other parts of the organization. Quickest way to fail. It begins with going to them, understanding what they're doing, what their goals and objectives are, trying to find those ways to link up your goals and objectives with theirs, try to show the mutual benefit of having high quality inventory information, so that your guy in supply chain doesn't realize he has 40 weeks of inventory on hand and he's still placing orders. And once those orders are on a boat, you can't stop them or return them, right? And so, there is a virtuous cycle in all of this, and you just have to take the time to find those data points or those arguments as to why it's important to do things a certain way. And more often than not, you need to find it to a way to explain it in a mutually beneficial way if you're asking resources from outside finance and accounting to help you with your finance and accounting close.
All right, this next one, this is the last one. I actually have one last thing, but that'll only take a minute. This is my fixation on marketing. And you and I have talked about this before. The only place that I've ever experienced it deeply was at America Online, when I was the guy running contribution margin, which generally is a marketing function, but it is related to finance and works with finance, or should be working with finance, mainly because you need to recategorize items on your P&L to figure out what's fixed and variable costs. But I just wanted you to comment on this. You and I have talked about this before. There's a difference between gross margin and contribution margin. And when we talk about, which you were just saying, you come in and do this cross-functional sort of bridge building if it's not existing. That bridge building happens with marketing too, because if marketing doesn't understand how to do contribution analysis and is not working with finance to help understand how to recategorize variable and fixed costs to get a contribution margin, and only does it on gross margin, then you truly don't understand profitability of a business unit, if you will, division, product, or service. So I know I warned you about that I was going to go down this rabbit hole for a second, but can you talk a little bit about this?
Yeah. So we're talking about the income statement, or P&L, people call it, profit and loss statement. So that starts with revenue. And then after revenue might have a deduction for returns, right? People return your product sometimes. And then you might have some coupons or something. And then you get to what we call net revenue. After net revenue, you start subtracting out cost of goods sold. So what are you selling? Are you selling hardware? Are you selling software? If you're selling a piece of hardware, that likely has plastics, that has computer chips, that has all sorts of complicated mechanical machinery in it. That is a cost of goods sold. The labor it takes to make that product is a cost of goods sold. So when you take those what we sometimes call BOM cost, bill of materials. So it's the plastics, the chips, and all of that that go into the product. And then you take the labor and you subtract that out from your net revenue. That's called cost of goods sold that you're subtracting out of net revenue, and you end up with your gross profit. Gross profit, you also have a gross margin. So the gross profit is the dollars, the gross margin is the percent. So if you sell $100 worth of stuff and it costs you $40 in COGS to make that stuff, you're going to have $60 left over, and you're going to have a 60% gross margin. Okay. So we'll pause there. We just talked about the walk on the income statement from gross revenue minus discounts, returns, net revenue minus cost of goods sold, get you to your gross profit. In internet businesses, I'll use that as an example, direct to consumer businesses that I've been involved with. The next few steps on the income statement are what we call variable costs. These are costs that are directly tied to the level of sales activity you're doing. Examples are credit card processing fees, fulfillment fees, right? Getting the product to the customer. Performance marketing, we just touched on that. So this is ads on Facebook, ads on Instagram, ads on TikTok, all of those sorts of things. And then the third category that we have at the company I'm at right now in variable is customer service. So the amount of phone calls we get depends on how many things we sell. And people need help because the product's not working right or they're not following the directions. And so customer service is another variable cost. So we take our gross profit.
Variable cost directly related to the product or service line that we're talking.
Yes.
Or division.
Yeah. I'll get to that in a second, that element, and I'll give a real world example. So these variable costs vary with the level of sales activity. We take our gross profit dollars and we subtract out those three cost categories, and we get to what we call at our company contribution margin. Now, every company might get to contribution margin a slightly different way. This is not necessarily a GAAP defined term. Gross margin is pretty well defined within GAAP. I've seen actually companies that include the fees and fulfillment in gross margin, and some that actually don't. I looked at in D2C, I looked at a cohort or peer group of about 15 public companies, and half had fees and fulfillment in their gross margin calculation, half had it below in variable. So anyway, we go from gross profit, we take out these three variable cost categories. I'm using a specific example of the company I'm at, and we get to what we call contribution margin. Contribution margin is meant to imply how much money do you have to cover more of those fixed costs. What's an example of a fixed cost? My salary as CFO, right? The insurance for the business, the internet that connects us to the outside world, the office space we have. These are all more costs that are fixed in nature. They don't change with the level of sales activity. And so when you look at contribution margin, you're trying to see how many dollars is this business putting out to cover those fixed costs that are really unavoidable. And those fixed costs go up from when you're a tiny little company with barely an office, you're working out of your garage, you don't have insurance at levels you should. As you get to be a really big company, you need to legally have insurance, and you need a larger office. You might need lab space for your people to do R&D. And so just pointing out that fixed costs tend to grow. We try to do as much as we can to get leverage out of those fixed costs, but like you don't need to add a new office space every time you hire someone, right? You tend to get an office space that can grow with you. You buy an extra 20% of room for those hires you're going to do over the next couple of years. But anyway, contribution dollars, contribution profit is the money you have left over to cover those fixed costs. Now, you were given an example of looking at contribution profit across, say, channels or products. Yes, this is extremely important because you could be selling 5 products that are somewhat related, and 2 of those products could be making you money, and on the other 3, you're spending so much in performance marketing to get people to click buy that they're losing money for you. Now, those products where you're losing money might be the products where first people discover your company. So they're sort of loss leaders, and you make way more in profit on the other 2 products in the long run to cover those initial sort of acquisition costs. But long way of saying, once you figure out contribution profit for your whole company, you very quickly want to try and build that out by the different channels you're in or the different products you sell. What are channels? At my company I'm at now, we have a direct-to-consumer channel. So we sell on our website. We have a retail channel. Those are stores or websites for those stores, the Targets, the Walmarts of the world. There's Amazon, right? Amazon's a pretty costly channel. And there's different ways you can do business with Amazon. FBA, fulfilled by Amazon. Then it's like FB customer, fulfilled by customers, all sorts of ways you can do it. Another channel we have is we sell medical devices. And so we sell them through the insurance channel. And so, and then we have one more. I'm just trying to think, retail. And then you could almost say like international is almost its own channel because it's just can be a very different look and feel when you take a product that you sell in the US, you try to sell that internationally. But or you could just look at your contribution profit, US versus international, right? That would be 2 good ways to look at it. But anyway, we have multiple channels. The insurance channel for us is extremely profitable from a contribution profit perspective. We get 30% contribution margin in that channel. In insurance, it's because we don't market to people. They just go right to the insurance company and they try to get reimbursed for the product. Now, our D2C, we have to do all that performance marketing I mentioned to drive awareness of our product. And so we spend a lot of money there. That is our second most profitable channel. Our least profitable channel is retail. That's because you have to sell your product to retailers. These are big, huge global companies. They really negotiate you on the price. And then you have to do co-promotions with them. There's chargebacks they charge your company for. The more you sell, it feels like the more chargebacks you end up paying. And so, what we're looking at today is we're looking at contribution profit by channel and seeing we have a really profitable channel, but it's limited in its scale, the insurance channel. We have our website, which is where we started everything. And over time, we've been adding retailers. Now, retailers get us more exposure. People are walking through the store. They see our product. A lot of people like to go buy the product and touch it and feel it before they buy it, right? So retail gives them that chance. But as we're adding these lower contribution profit channels and building out our retail channel, that's hurting our overall business because what we're seeing is some of those people who used to buy on the web, now that they have a chance to go to a Target or to a Costco or to a Walmart and see our product, they're going to want to do that.
So that's cannibalizing one channel.
Yeah. And so, and the more you do that, the lower the contribution profit gets over time because your mix is changing from that profitable direct-to-consumer channel towards a less profitable retail channel. So there are benefits to being in all of these retail stores, right? Brand recognition. If the competitor's on the shelf, you want to be on the shelf, especially if a better product. But there are costs to it, and understanding that cost. So, like, you just don't wake up one morning and go, "I'm just going to sell everything in retail. I'm tired of dealing with the website and direct-to-consumer sales. I'm tired of dealing with these insurance companies." And you make that decision because you don't know what your contribution profit is across these channels. And guess what? You're out of business like 6 months later.
Does and shouldn't. So contribution margin, when I worked back in the day at America Online, I was the guy. I think I was the guy for all the premium channels, premium services. I sat in marketing, but I did have to work with finance because I needed to pull out variable costs as it related to those product lines. So I needed their help. Do you think that sits in marketing or finance? It probably could sit in both. I think they sat me in marketing because I had access to the data, like I had a data scientist next to me who back in those days, we had a separate person who pulled the data when I needed it. So, but it could be in either place. But sometimes marketing doesn't want to do that because marketing wants to build creatives. They want to come up with slogans and they want to run A, B, C, D, E, F tests, which I'm not knocking on, are very important, and then report on the metrics. Versus if you build a contribution margin, you can actually, instead of reacting to your marketing dollars, instead of saying, hey, we have $100,000 to spend on Facebook ads, getting the results with the contribution analysis or contribution margin analysis, you can now say, oh, by the way, on that $100,000, you need to hit X goal for us to actually make money, which is a very different approach than this it's really top-down marketing instead of bottom-up. Would you agree with that?
Yeah. So let me unpack that a little bit. So first, I think you're talking about where should this expertise and this analysis
Yeah,
sit?
that's the first thing.
I mean, it depends on the scale and size of your company. In a perfect world, I think it sits in finance because, to your point, then the marketing people can focus on the ABC testing they want to do and building out the brand and all of that stuff that we're not good at in finance and accounting. Let's be clear. So in a perfect world, the analysis and the reporting sits in finance. That's how we become a good business partner. We highlight things to them that they can't see through other means. And so, but in fast growing companies, small, medium sized businesses, you're going to have very you're going to have people in marketing that can do a lot of things, right? Because they've been in startups before in all likelihood. And so they've had to wear multiple hats. And so in this example, they might be the person trying to cobble together a contribution margin. What I find is when the business functions try to do accounting, they don't do it right. They do it on a cash basis and miss a lot of things that they aren't thinking about. Like, I've run into situations where an operations group's trying to put together a P&L and they forget that like salaries have benefits costs on top of them and payroll taxes on top of them, right? And so we in finance know you just typically in the US, you add 22% on top of someone's salary to get their fully loaded costs.
Is that the general number?
Yeah.
That's taxes, benefits, 401k.
Yeah, that's like in the US, yeah. 22%. If you're going to put in like a 401k match, it's probably a little higher, like 22, 23, 24%. But yeah, it's at least 20%. And so we call that the burden. So if you make $100,000, we're going to burden 20% on top of that and follow through our model at $120,000 cost as an example. So I don't like people outside finance trying to create P&Ls because it's a waste of their time. They think it's important and it is important. I'd rather hire some finance people.
Well, it's a hybrid, isn't it? It's a marketing finance person.
Yeah. Well, it's a finance person that does business support for marketing. So, right.
So they do have right. So not all finance people are well versed on the marketing.
Right.
So you got to be that. It's a niche.
If I can find a smart kid, a couple years out of college, maybe they were working in an accounting firm, maybe they were working on Wall Street, and I can bring them over. They'll learn marketing really quick. They just need to listen and spend time with the marketing experts, right? So the way I do that is I bring them on board in finance, FP&A, business support. I use those terms interchangeably. And I tell them to go out, go to the staff meetings, have one-on-ones weekly with the marketing executive and lead or whoever has the time to talk to you, start building that relationship, find out what their priorities are, find out what their goals are for this year, find out how much revenue they have to bring in or whatever the numbers are, understand their budget, understand how their spend is recognized in a P&L. And so just really try to immerse yourself in their world and then bring that knowledge back, take the numbers from accounting and try to start helping them better understand their business and drive their objectives. So I'd rather sit in accounting. So that was the first part of your statement is you had to sort of do that. You were doing that job and you were sort of stuck in the middle almost, right? You weren't.
Well, I'm a consultant who's basically working between both of them. They probably somebody higher than my pay grade sat me in the marketing to put it on that P&L instead of finance. So I'm really a finance person, not on the finance P&L, so that it came out of the marketing budget is most likely.
Yeah,
probably how that works.
If you were a marketing person trying to do finance, I'm not going to get great return on my investment in you. You're distracted from your core responsibilities and your core superpowers. I want you focused on your superpowers and leveraging those for the benefit of the company. The other part of this is You can't do this contribution margin analysis unless you set up your chart of accounts, you have policies and processes in place that get information booked into the right account. You have the ability to take the data in the accounting system, and hopefully it's in a cube, a data cube, and you can slice it and dice it. So I can understand that this revenue is related to this channel, this cost is related to this channel, this marketing spend is related to that channel. If you can't sort of set up your data model in accounting, we call it a chart of accounts, but also it's the chart of accounts, it's basically the chart of accounts. If you can't set up the chart of accounts in such a way to get this information out, you're going to be spending a lot of time trying to make things up to try to get to this contribution margin by channel, right? And it's not going to be
or by product
anyway. So just a little bit of a pitch that this all goes back to the beginning, especially when you're putting in a new accounting system. It needs to be able, the chart of accounts and the data model have to be able to support your business and how you look at your business. And the thing is, you're probably not even looking at your business all the ways you can. This new system will enable you to look at your business in different ways because it's a much more has the capability to do more complex data models and things like that. So you need to spend the time up front talking to the business. What's important to you? Is it profitability by product, by channel? They'll probably say both. And then you need to make sure you set up your data model so you can get that information out of your accounting system. If you don't do that, you're dead in the water.
It's almost like you have a finance marketing department. And I just see a lot of companies miss it, Sean. And they're saying, especially in the early days, and I see big companies like, hey, where's your contribution margin? You go into marketing. They're like, I don't know.
Yeah. I mean, if you hear the most frequent one I hear is sales finance, right? That's the first combination of finance with some other function that you commonly hear, sales finance. These are people who, on the finance side, they're measuring profitability of contracts before we sign them, things like that. So I've heard of big companies having sales finance teams. They typically will report up through the CFO, but they can also report up through the for the sales leader. Just depends on the company.
So they go there first, but then they miss this marketing. And how much a percent? Marketing can be a big percentage of your total revenue, I guess.
Yeah.
Right?
Yeah. No, performance marketing at direct-to-consumer companies could be 25% of your revenue.
So if you're not doing contribution margin, you could find yourself in big trouble.
Yeah. But back to my example, I'm spending that 25% on the D2C channel. The insurance channel, I spend no marketing on, right? Now, to be fair, some of that D2C marketing I'm doing is driving awareness, right? And so do you attribute all of my performance marketing costs to D2C? You could do that to be conservative and make yourself more comparable to other only D2C companies that are only do D2C, so you can compare metrics. But the point being, yes, you need to know how much you're spending in each channel to drive profitability, and it varies by product, as you said, by channel. There's other ways, business unit. I mean, there's all sorts of different cuts of contribution margin you can do. As I said, domestic versus international might be a cut you do. So very important tool to understand where you're making money and where you aren't making money, and then you can make decisions about whether you want to continue losing money. Is it for a purpose, or is it not for a purpose? If it's not for purposes, you might want to de-emphasize that part of your business.
Now, I'm just going to roll another grenade in, but we're not going to completely unpack it. Is you also, especially in businesses that have churn, if you not running your churn curves in your in your entire financial model, but especially in your contribution margin, then you're actually getting the wrong number, and people miss running those churn curves.
Yeah, you're sort of getting into, there's a lot of metrics in the sort of direct-to-consumer internet space.
Well, I'm diving into that because there's so much subscription businesses now, right? So even you buy the product, and now you buy the Peloton, and I've got $49 charge every month. I mean,
right. So you're getting a subscription business, SaaS, and metrics. So this is sort of beyond the P&L. A lot of these key business metrics, almost in a way, are based more on cash activity. And you can get them more real time now with the tools, whether you're placing ads on Google. They have all these tools that tell you real time, like how your spend is performing. But there's a lot of metrics, and each business has different metrics. So you were talking about subscription businesses and churn. What's churn? Churn is like how many customers that you sign up are staying with you and continuing to pay monthly
throughout the cohort.
Yeah, throughout a cohort. We'll get to that in a second. Versus how many are canceling their subscription and disappearing. If you have a net positive, sort of churn, you're adding more customers than you're losing. That's fantastic. You talked about cohorts. Yeah, we look at things, metrics in cohorts because it's helpful. So we typically, in the business we're at right now, we're looking at quarterly cohorts, but you can look at monthly cohorts. You can look at cohorts across a different attribute, but essentially what you're trying to do is look at groups of customers and how are they spending over time is one example of sort of cohort type analysis. So I spend $60 to acquire a customer. On the first purchase, they generate $200 of revenue for me. Maybe they sign up for a subscription that produces another $120 over the course of the first year. So now I'm at $320 in my first year against that $60 acquisition cost. That's not bad. But you want to make sure that they're in a cohort, my Q1 cohort. Well, I ran a marketing campaign in Q2 where I doubled my performance marketing spend. How's that cohort performing? Right. And so that's why cohorts are important to group customers into some sort of grouping, because it allows you to do some of that A/B testing. In Q1, I really cut my performance marketing because, I don't know, it's when everyone goes on vacation. But in Q2, I doubled it for my normal levels, and I want to see how that cohort is spending money with me. Did they buy the add-ons to the subscription? The subscription was $120, but did they buy the two add-ons we offer that adds another $80 of subscription revenue a year? And now I'm at I'm at $400 against that $60 acquisition cost. So yeah, there's a lot of metrics that exist outside the financial statements, and each company's different. And you can get a lot of those metrics quicker than you can get financial statements. So I don't poo-poo people who are looking at those things, because it gives you a real sense of, I call it the heartbeat of the company, like what's going on the front lines, where that's looking at cash sales on Shopify. Like every day I sold $1 million today. This same day last year, I sold 500,000, right? So you can look at Shopify enables you to do that, look at that kind of stuff daily. And so does when you're placing ads on Facebook and all those sites. They have a lot of real-time information tools, and you got to build metrics, just like you got to build your chart of accounts and accounting. You got to build metrics that everyone buys into. You got to define those metrics so that people aren't miscalculating them or misrepresenting them to your board or to outside investors. So you got to make sure you have tight definitions around those metrics. And hopefully those metrics show that on top of your financial statements that your business is doing well.
Well, I appreciate you going into that. I just think it's really important. I think a lot of people miss that. And then you talk about finance in general. It's sort of everything else we talked about, which is a lot. We've covered it in 2 hours and 1 minute. So I'm going to throw a curveball, but you listen to the podcast, so you would expect this, is if you were to only be able to say three pieces of advice, HPTs, high percentage tips for people building a finance and accounting department, what are those three things?
Hire high quality people. Create an environment where people feel like they're part of the team and they can grow and develop their own careers, while also sort of helping this business grow. And listen, as a leader, you need to listen to your own people. You need to listen to people outside of your part of the company and other parts of the company. So you have to be willing to listen, because I don't want to be viewed as, a cost center, someone who only places financial burden on the company. I want me and my team to be viewed as value adders, people who are really helping drive the business. And so you got to go out, you got to listen and build relationships in a company.
I think there's a good tips. If somebody wanted to connect with you, either a question or maybe hire you or whatever they want to do, can they reach out to you on LinkedIn?
Yeah, I'm on LinkedIn. I got a handsome picture of myself that looks where I look much better than I do here, sitting in your podcast room with my flannel on. But yeah, always feel free to reach out on
We're
LinkedIn.
in Northern California, dude. Like, you can wear anything you want, right?
I know. It's so funny. I have kids, and when I grew up, I used to have to wear like khaki slacks and all that. And in New York, we wore suits to work.
Yeah.
And out in California, we all wear jeans to work, right? And that's been going on for a long time. Well, my kids now view jeans as like not cool, right? Because dad wears those to work. And so it's just so funny. I would have killed as a kid to be able to wear jeans in most situations. And now jeans are considered kind of dorky. And
I didn't understand that. What are they wearing? Shorts?
they're wearing shorts or they're wearing leggings. Yeah,
All right. Well, we got Jeans on today and we're still cool. So thanks a lot for spending the time, 2 hours. This is really deep dive. I think it's extremely useful. It's a really important topic. It's not always seen as the sexiest of things, but it's the money part, and that's the heartbeat of any company. So thanks for coming in, man.
Yeah, thanks for having me. It's great spending time. Thanks for pouring my water throughout the podcast.
Yeah, right on. Bye, everyone.